This is the Friday, October 7th, 2016 version of the Market Plus segment. Joining us now is Tomm Phitzenmaier. Tom, welcome back.
Thanks, Mike.
Hey, we're glad to have you. It's tough to believe it's already October, isn't it?
I know. It's flying.
Oh, it's scary. We did not get a chance to discuss the cotton market on the program. Down $1.10 on the week. Are we just going to keep dropping this thing all the way through harvest?
You know, that was kind of an interesting week in cotton because we had that big spike up in the middle of the week as people anticipated Hurricane Matthew and the impact that might have. Then as the week went on, we kind of said, well, maybe that's not going to be that big a deal. And I don't know, I guess we're going to have to see what happens when you get up into the Carolinas, whether if it starts to come onshore more than they're anticipating, then you could see cotton bounce right back up again. And certainly I think if you get in that 68 to 70 cent range, you probably have to be a seller. If they break it back down in that 64, 65 range, I guess I'd sit tight and see what happens here.
Okay. From a speculative position, if cotton breaks back down into 63, 64, given how range-bound it's been, would that be a buying opportunity for a speculator? Or re-ownership?
It would for me. I just think you're right. You've got a pretty good base of support there that you can buy against, and I think it'd be worth taking a stab at it down there.
Okay. Now, we've got a lot of questions from our Facebook and Twitter followers, and they are curious about soybeans, Tomm Phitzenmaier. And these questions are from Iowa and Minnesota. And I've got a feeling yields are looking pretty good in that part of the world as guys are finishing up with soybeans.
Yeah.
So first one is from Tim in Crookston, Minnesota. Tim wants to know, is the bottom in on soybeans? Then he says, please say yes, please.
I don't think you can say that. Like I indicated on the show, if we have a 53, we had 1 year when the bean yield, well, I think it was 2004, was 120% of the trend line yield. If you apply that same percentage to the current trend line, that's a 55 bushel bean yield. So I think you have to, that's why I said on the show, that's probably what the upper limits are at 55, but it's not all that uncommon to be in that 113 to 114%, which would be 52.5 to 53, possibly 54. I just think at some point the Chinese are probably going to back off on their buying a little bit, especially with South America getting planted in a fairly timely manner with good moisture. Possibly the beans low is in, but I don't think if we have a higher yield than they're expecting to now, I think you can go to $8 in beans.
And really, given how the USD operates, we're probably not going to see a 54, 55 until January, would you think? Okay.
Yeah, that's the interesting thing. I read this week that the average low for beans was Friday, today.
Okay.
Well, that's really interesting, 30-year average. Well, yeah, but we had some years when it was January and somewhere when it was July. So, I mean, it doesn't really tell you a lot.
So don't go buy beans today.
And if the crop keeps getting bigger, you're right. Then January that January report is when the biggest number comes, and the low could be put in. So that's why I'm not that uncomfortable with making a few sales and getting some beans kind of shored up on rallies here. I don't talk to anybody that doesn't have a bean yield that's a lot of times 5, 10, 15 bushel better than the farm's ever had before. So, I mean, I just don't, we wring our hands over a bushel or two increase. It could be more than that.
Boy.
So, sorry, I couldn't give you the answer you wanted there.
Well, you raised an interesting question. We've got another one here from Dan in Prairie City, and he's asking, what's better? Same scenario. He's asking, do we store beans, or do we sell the cash and re-own in July 2017 futures?
I certainly, if you're gonna re-own beans, that's probably not a bad place to go because you aren't buying into a big carry. I don't think re-owning corn out in July is a good idea at all. But it's probably not that bad in beans if you want to bet on a La Nina, which there's talk about that possibly coming in and affecting the South American crop. So there's some things sort of floating around that could be positive, and if you want to maintain ownership that way, that's probably not a bad idea.
And if you're going to make that ownership, you'd probably do it outright in the futures rather than pay the time value on an option.
Yeah, I guess I would. I just think you're going to buy an eroding asset when you go out and buy a call out there. I think you'll be immensely disappointed.
Okay. So just write the check for the futures and
Yeah, pretend
tell
like
your banker what you're doing.
pretend like it's the beans you got in the bin and act accordingly.
All right. Third question. We've talked a lot about supply. We've got ample supply, it would seem. Mary in Iowa wants to know, what is the demand for corn and soybeans in the near future, and where is that demand?
Well, let's start with corn. Ethanol demand is one of the three legs of the stool of demand. That is, I think, fairly set. I don't think you're maybe you'll have 5.25, maybe 5.3, something like that. It's not going to vary all that much, given how much the size of the crop could vary. So I think that's fairly well set. Export demand, I think we have a pretty good handle on it. It's maybe going to be a little bit better. The U.S. is somewhat competitive on the world market. Black Sea region feed grain wheat is a little bit cheaper than what we're selling, but it's pretty close, and we've got the cheapest corn. South America's not going to have any for quite a while, so I think you're going to see good export demand, but that's already plugged into the equation. We know that. Maybe they bump it a little bit in the Wasley report Wednesday, but probably not a big deal. Feed demand is really where it's kind of, you know, all those other ones we get a weekly report on what's going on. Where feed, you don't really know. Cattle and hog prices are going down because there's too much of it, which means there's probably critters out there eating. So I would guess demand, if anything, got pushed up a little bit. Maybe it could be the demand. Everybody thought that there was some switching of corn to wheat this summer because feed grain wheat got pretty cheap, but that stocks report sort of confirmed that didn't happen. So that maybe should make you a little more optimistic about the feed side on corn. As far as beans go, totally, I mean, not totally, but primarily driven by export demand, and that's driven by China. So our sales are way ahead, our shipments are way ahead. Obviously, the Chinese are buying it and they're saying, get it over here. We want to have control of those beans. And I think, like I said in the show, to some extent, that's a hedge against potential South American problems because they saw what happened last year. Now, we are predicting, you know, probably almost 2% increase in their acreage down there.
In bean acreage.
In bean acres. And if they get off to a good start, you know, they do have the potential to produce a, you know, 104 million metric ton crop, which is going to make that Chinese demand probably go away after, you know, February or so.
Okay. Domestic crush has been very strong on the bean side.
It has, and that's related once again to livestock numbers being strong, so there's a good demand for the meal.
Okay.
That may be hindered a little bit because the Chinese have sort of put some roadblocks up for DDGs, so there's going to be some DDGs available in the U.S. that are going to compete with meal. So that Chinese dust up with the DDGs probably had more effect on meal than it did DDGs.
Yeah, which we've seen in the meal pricing. I mean, dropped from $400 to $300.20 where we closed.
Yeah.
Speaking of meal, are you buying down here, or do you wait to see if this erodes any further?
I guess I'm waiting to see if it erodes. Okay. Although you know, if it works for your livestock operation and you can buy meal here and locking in some decent profits, it would be hard to argue against doing that. But meal's definitely in a downtrend, much like beans are. So I don't know that there's a big hurry here.
Okay. Now, as we're talking about trade, you mentioned China's buying. We're seeing some potential for exports. Maybe corn to South America was talked about earlier in the year. What's the dollar going to do? How much of a headwind is that going to throw at us here into the future?
Well, it's going to. I don't think there's any question that is going to be a problem. If you've got the trade talking pretty positively that we're going to see a rate increase, that maybe not in November, but probably by the end of the year. So if you just look at central bank policy, the U.S. dollar is on an upward trend in terms of interest rates, whereas the rest of the world's going the opposite direction, or is at least stable. So it looks to me like you're going to continue to see upward pressure on the dollar, which once again hurts exports, on all of the commodities that we're trying to export out of the U.S.
Okay. And, other commodities that we can export, the big talk over this past week, thanks to some announcements by our friends in the Middle East and the Russians, is crude oil. $50 a barrel. Are we going to hang out? Are we heading to a new high, or is this the top? Now we're time to sell and move low.
Well, that was all predicated on an agreement between Russia and OPEC and Iran, and then they came out and they excused Iran and said, well, you can do whatever you want, which puts a hole in the bucket right off the bat there. And if you think that there's not going to be the possibility of the Saudis and the Russians cheating on that, you're crazy. And then you take U.S., the 5-year seasonal average on crude oil is up about 34% from the 5-year average. So we've got tons of crude that we can export. I mean, that rally is nice, but it's based on smoke and mirrors, I think. You're in all likelihood going to see that slip back into the 44, 45 range. I wouldn't want to be long crude above $50 for anything right now, based on those circumstances.
And we've seen how easy it is, or not easy, but how quickly those rigs can get back to drilling in the Bakken and the Eagle Ford and the Permian Basin here in the U.S.
Yeah, and they will. I mean, at above 50, they're going to make that happen. Not in a way that they were a few years ago, but there's stuff's going to come back online.
All right. Tomm Phitzenmaier, before we let you go, we want you to define a term frequently used in trading. And could you tell us, what is a strike price?
Strike price, when you trade options, you have to say, I want to buy corn at $4, for example. I want to buy a $4 call. That means you want to buy the right to be long corn at $4. Well, in order to trade options, you have to have those prices established. So the $4 is what we call the strike price. In corn, it tends to go in 10-cent increments. So $4.10 would be the next strike price. $4.20. If you're buying calls, the higher the strike price is, the cheaper they tend to be because you're farther out of the money. There's another term you maybe define at the next show.
The current market price.
Correct.
Yep.
So the strike price is just the pre-established price that everybody's trading off of in terms of where they want to be long or short, the underlying futures against that option.
All right. Well, Tomm, thank you so much for taking the time to join us this week.
All right. Thanks, Mike.
Thanks to all of you for sending in your questions via Facebook and Twitter. Please continue to do so, and check out our podcast, M2M. Find it wherever you get podcasts. Thanks for watching, and have a great week.